Hello, I'm Raul Elizalde with a quick take on the markets. In my last report I said that we needed good news and fast from Europe because the situation in Greece was getting so much worse. Also that the only strategy left to deal with Greece was to throw a lot of money at the problem and hope that markets calm down. Well, we got what we wanted. The amount of rescue money was beyond everyone's expectation. About $1 trillion to save not only Greece, but also to prevent a blow-up that would have extended to Portugal and Spain. Not only we got the short-term bandage, but also we got more long-term meaningful good news, such as an unsolicited austerity package in Spain aimed at cutting down the deficit, and the same from Portugal, which also announced that it grew at 1% in the first quarter, or 5 times faster than the rest of the European Union. And in the UK, the Conservatives and the Liberal Democrats are now in joint power, and that is supposedly the option that the market wanted to see. So we got good news, and the train wreck has been averted, or maybe just delayed. What now? Well, it remains very likely that Greece will default on its debt. Cutting down the deficit from 13 or 14% of GDP to only 3% by 2014, as they pledged to do, seems unrealistic to say the least. Greece doesn't have its own currency that it can devalue and gain competitiveness, so the only way to cut the deficit is through a horrific contraction. Given the political difficulties of doing it that way, it seems reasonable to expect that at some point Greece will not only default on its debt, but also abandon the euro. But this cannot be done right now, because the markets are way too fragile to ensure an orderly transition. The only hope is that $1 trillion buy enough time for Spain and Portugal to improve their fiscal accounts to the point that if Greece leaves, it would not be a threat to them. The road is long, and although it seems that the panic has receded a bit for now, the problem is far, far from over. We will just have to wait and see. Meanwhile, Asia is plowing ahead, barely affected by all this, and the US continues to show consistent improvement both on economic activity and on the jobs front. So, is it time to relax a little? Well, the answer is probably no. Volatility has gone up a lot in the last few days, most notably last week, when the Dow lost 1,000 points in minutes before gaining most of it back. Higher volatility may well be a signal that the bull market of the last 15 months has ended, because typically when volatility goes up, the market tends to be constrained at best, or go down if volatility gets too high. And after a 70% bull market, it's time for a pause, at least. If we avoid an implosion in Europe, the best that we can hope for now is for markets to trade within a range. This will force investors to search for those assets that have the best return potential. For example, so far this year, REITs and small cap stocks have done very well, while foreign stocks and commodities in general have done poorly, partly because of the US dollar strength. This might change in the second half of the year, we don't know. But the point is that if we are in a trading range, investors need a thoughtful asset choice to invest successfully. But most of all, what investors really need is a clear understanding of what they would need to do if all hell breaks loose. As we saw at the end of 2008, just watching how the market decimates your investments is not the way to go. For more information, please visit us at www.pathfinancial.net. And Raul Elizalde, thanks for watching.